April 2022 National Real Estate Update. Hi everyone, Jessie here with the Jessie Bandwidth Group with the eXp Realty. Hope you're all doing well. Each month my aim is to keep you informed on the happenings of the national and local real estate market. The market has officially shifted. Home sales start slowing in secondary markets like KWC, Milton, and Barrie at the beginning of March, and now the slowdown has transitioned into primary markets like Mississauga and Toronto. We can see the trend happening all over Canada, from Vancouver to Quebec. The average national price for a home in Canada, all types, all locations, has dropped from February's record high of $816,720 to $796,000 in March. However, this is still a year-over-year increase of 11.2% nationally. Although each segment of the real estate market is being affected differently, this is fundamentally related to price, location, and lastly, condition of the home. Now in this video, I'll be bringing you 6 key subjects. Number 1, interest rates and inflation. Number 2, our national home sales update. Number 3, federal housing budget. And number 4, mortgage market update. Number 5, employment. And finally, number 6, immigration. Now let's start with interest rates and inflation. A big surprise here, as Bank of Canada raised the overnight interest rate from 0.05% to 1%. What choice do they have? Stats recently report that Canada's inflation rate jumped to a new 31-year high of 6.7% in March. Cheap money and supply chain shortages are the primary drivers of inflation in the above chart. However, this is based on a 12-month average. I think the numbers will be a lot worse based on 3-month averages. As for inflation, in my opinion, it is a lot more. Examples of this have to do with my recent experience with the used car market and purchasing of hardwood flooring, both of which have surged a lot higher than 6.7%. We can be certain we'll be seeing a few more interest rate increases by year's end. And did you know that real estate is one of the best hedges against inflation? Number 2, National Home Sales Update. There's a lot to talk about in the latest home sales data, so I'll jump right into it, starting with the largest increase in active listings since 2010. Active listings are up. National listings inventory across Canada was up 7%, while the GTA was up nearly 30%. The increased inventory was attributed to sellers trying to take advantage of the hot spring market that was particularly notable in Ontario, as the chart shows. We've now seen 205,000 new homes complete in the past year, with a record 310,000 still under construction. Construction activity is very high, and we should expect completions to remain near record levels right through to the end of the year, and that means more supply to trickle into the resale market. Now, a pullback in demand is still likely, as sales remain 25% above normal levels. Home sales nationally jumped 4.6% month-over-month last month. They remain 25% above average levels on a population adjusting basis. The market is still extremely tight. Even with a significant supply being built, months of inventory remain stable at a record low of 1.6, where it has hovered now for 3 months. That level of tight supply all but assures positive pricing trends likely right through the spring selling season. At this point, the typical home in Canada is now $200,000 more expensive than a year ago. The federal housing budget. The federal Liberal government focused April's 2022 budget on housing affordability. Let's talk about some of the measures proposed. First, a ban on foreign investment in Canadian housing. The Liberals proposed a 2-year foreign buyer ban, arguing this would ensure that homes will be for Canadians rather than for wealthy foreign investors. This policy, of course, has many loopholes and exemptions. The government decided to exempt foreign students from this ban, allowing wealthy parents of foreign students to buy a house or a condo to live in while completing their studies, and also allows foreign investors to buy a home through a corporation. Next, making property flippers pay their fair share. Currently, anyone selling a home today that is not their principal residence would be taxed on their capital gains, which is the appreciation of the value they have gained since they purchased the property. Budget 2022 proposes that any person who sells a property they have held for less than 12 months would be considered to be flipping properties and would be subject to full taxation on their profits as business income. And lastly, taxing new condo assignment sales. Budget 2022 proposes to make all assignment sales of newly constructed or substantially renovated residential housing taxable for GST/HST purposes effective May 7, 2022. The reason for this proposal is that much of the demand for pre-construction condos in 2022 has come from investors who have no intention of taking possession of the condominium. They're buying pre-construction condos for the sole purpose of flipping or quickly selling the property for a profit before building is completed. The practice is known as an assignment rather than a sale. The federal budget proposes to begin taxing assignment sales for HST purposes. This measure could have an impact on the new construction market if this additional cost makes it harder for speculators to assign their units for profit. Number 4, mortgage market update. Borrowers are beginning to feel the pinch of rising rates. The mortgage renewal gap has hit the highest level since the early 1990s. This metric measures the change in monthly payments on fixed rate mortgages at the first renewal for every $100,000 originally borrowed. The latest reading puts the gap at $60, which means a borrower who took out a $400,000 fixed rate mortgage in March 2017 is facing an increase in payments of $240 per month if they opt for the same term today. Also, fixed rate mortgages are now seeing rates rise almost on a daily basis. However, we have to take into consideration that the borrower would renew at the same mortgage amount, which is not typically what happens. In a 5-year period, the borrower would have paid down a significant amount of principal, and that would offset some of the increased payments. After years of low interest rates, how will higher interest rates impact the housing market? Well, the biggest risk to home prices, at least from my perspective, is that tomorrow's home buyers will be paying 5% on their mortgages compared to the low 2% range just a few months ago and the 1% range just a year ago. Then, a buyer who qualifies for a $1 million mortgage may be willing to take on that much debt when interest rates are 1.75%, but less so when rates are 4%. Because under the higher rate, their actual mortgage payment would be roughly $1,100 per month higher. Number 5, employment. Now the macro backdrop still looks solid. Canada's job market continues to perform well, adding nearly 340,000 new positions in February and fully recovering to the 200,000 jobs lost in January amid the Omicron surge. The unemployment rate fell to 1% to just 5.5% overall, the second lowest reading on record. Meanwhile, job vacancies jumped again in the fourth quarter to hit over 900,000 across the country. Number 6, immigration hits new highs just as housing starts slow. Population growth continues to recover from the COVID lows, hitting 460,000 year over year last quarter. Now chalk this up to the single largest quarterly increase in immigration on record, with potentially higher to go if the federal government is to hit their 432,000 target this year. On the supply side, housing starts have cooled in recent months. The number of completed unsold homes in Canada hit a new 18-year low last month. If developers can build it, it's getting snapped up. This points to a continued undersupply of new homes, particularly in the single-family home segment. This is Jessie with the Jessie Bandit Group with eXp Realty. Thanks for watching and stay tuned for our next video on the local real estate market update. We help buyers and sellers make nice moves.